Gold at nearly $4,000 an ounce sounds like safety, but it keeps me up at night. Every headline screams essential, central banks are loading up, and Wall Street swears the only way is up. But the last time gold soared like this, in 1980 and 2011, late buyers lost decades to claw back losses. What if today's rally is a bubble about to burst, and the $19 trillion locked in gold is actually a colossal missed opportunity? Here's the part almost no one is telling you why price and value are about to collide. Holding gold feels reassuring because it is tangible and universally recognized. But there is a simple, often overlooked reality. Gold just sits there. 1 ounce in your safe today will still be 1 ounce in 10 years, no matter how long you wait or how high the price once soared. It does not grow, it does not multiply, and it does not pay you anything for the privilege of owning it. That is not just a philosophical point. It is the central flaw when comparing gold to any asset that actually produces something. Picture a piece of farmland. Buy it, and you are not just getting dirt. You are buying a stream of wheat, corn, or soybeans every year. Rents from farmers, profits from crops, and the land itself can appreciate as the world population grows and food demand rises. 10 years down the line, you still own the land, but you have also collected a decade of income and capital growth. Or take a stake in a business. Shares in a company, for example, a grocery chain or a manufacturer, represent the right to a portion of its profits. As the company sells more, innovates, and expands, it pays out dividends or reinvests to become even more valuable. Every year, your piece of the pie gets a little bigger, and the compounding effect takes over. Wealth builds on itself. Even government bonds, often dismissed as boring, quietly pay interest every 6 months. That income can be spent, saved, or reinvested elsewhere to keep your money working. Over time, the difference piles up. Now compare these things to a gold bar. No matter how many years pass, it never produces a cent in income. There is no dividend check, no interest coupon, no harvest. If you lock away an ounce of gold, you will open the vault years later and find exactly what you put in, nothing more. The only way to profit is to hope someone else will pay more for it down the road. That is not investing. That is speculating on price alone. This is the crucial distinction. Productive assets pay you, compound over time, and create real value. Gold, by its nature, cannot. It is inert. When you choose gold over a business, a farm, or even a bond, you are giving up the power of compounding, the most reliable force for building wealth ever discovered. That is why, for all its shine, gold's long-term role in a portfolio is fundamentally different from assets that put your money to work. The real cost is not just the price you pay at the top. It is the years of missed opportunity while your wealth stands still. Imagine every ounce of gold ever mined, from ancient tombs to modern vaults, gathered in one place. The total comes to about 208,000 metric tons. Stack it all together, and the result is a single, gleaming cube, each side measuring just 68 feet. It is smaller than most city swimming pools, yet at today's prices, this unremarkable block is worth nearly $27 trillion. That is the combined value of every gold bar, coin, and artifact ever pulled from the earth, calculated at $4,000 an ounce. For a sense of scale, $27 trillion is more than the annual economic output of the United States and Japan combined. But what does this mountain of wealth actually do? It sits, silent and motionless, locked in vaults, jewelry boxes, and central bank reserves. Not a single dollar of income comes from it. No crops grow, no factories hum, no new jobs are created. The entire cube could be buried in the ground tomorrow, and the world's productive capacity would be unchanged. Now consider what $27 trillion could buy in the real world. With that sum, you could purchase every acre of farmland in the United States, roughly 900 million acres, along with the crops that land produces year after year. You could acquire the 20 most profitable companies in America, from global tech giants to consumer staples, each one spinning off billions of dollars in dividends and growing stronger with time. And after all that, there would still be enough left over to buy a sizable share of the world's best commercial real estate, or to fund a generation's worth of scientific research and innovation. The contrast could not be starker. One option is a static block of metal, impressive in size but fixed in value unless someone else offers more. The other is a collection of assets that churn out cash, feed the world, and drive progress. While the gold cube just exists, productive assets multiply and compound. Over decades, the difference is staggering. The gold cube's value depends entirely on changing sentiment and price, while businesses, land, and real estate build wealth year after year, regardless of market mood. This is the real cost of holding gold at these levels. It is not just the risk of a price drop. It is the silent, relentless drain of opportunity, the decades where $27 trillion could have been working, growing, and improving lives, instead of sitting idle, locked away in a cube. That is the economic deadweight of gold, made visible. In late 2025, gold's spot price hovers just above $4,000 an ounce, with a recent all-time high of $4,379 set in October. That's a 60% climb in only 12 months, outpacing nearly every major asset class and dominating headlines across financial media. Analysts at Morgan Stanley and JP Morgan now openly discuss targets of $4,400 and $5,000, while brokerage houses call gold a portfolio essential. The scale of investment pouring into gold is staggering. Central banks have added 900 metric tons to their reserves this year alone, one of the largest annual purchases on record. China, Poland, and India have all increased their holdings, with Poland's gold reserves surpassing 500 metric tons, and China's official tally moving beyond 2,300 metric tons. For many of these buyers, gold now makes up more than 10% of total reserves, and some, like the Polish National Bank, are pushing for 20% or more. Exchange-traded funds have also seen historic inflows. ETF holdings stand near 3,600 metric tons, representing a massive pool of speculative capital. In the futures market, speculative long positions are at or near the highest levels ever recorded, rivaling the peaks of 2020 and far surpassing those of the 2011 cycle. On the COMEX, a single gold contract controls $400,000 worth of metal at current prices, with initial margin requirements around $14,000. This means traders are operating with leverage of nearly 29 to 1, amplifying both gains and risks. Despite the feverish activity, the underlying drivers are rooted in anxiety. Inflation, which reached nearly 9% in 2022, has since cooled to about 3 to 4%. Yet the narrative of runaway prices and currency debasement persists. Geopolitical conflict, trade wars, and talk of de-dollarization keep fear alive. Retail investors lured by stories of gold to $10,000 have piled in, while social media and mainstream outlets fuel the momentum. At today's price, the entire stock of gold ever mined, about 208,000 metric tons, commands a market value of roughly $27 trillion. That's more than the combined annual gross domestic product of the United States and Japan. The enthusiasm is quantifiable: record prices, record flows, and a market narrative that leaves little room for doubt. But behind the numbers, the mechanics of this rally reveal a market leaning heavily on momentum, leverage, and the hope that the next buyer will pay even more. Gold's meteoric rise in 2025 owes as much to the plumbing of modern finance as it does to fear in headlines. At the heart of this surge sits a vast and growing pool of exchange-traded funds, vehicles like GLD and IAU, which together now control 3,600 tons of metal. That is more metal than most central banks hold, and it is all owned by investors who can buy or sell with a tap on their phones. Every ETF share is backed by physical bars, but the promise of instant liquidity has drawn in waves of speculative capital, eager to ride the momentum. The futures market, too, is packed to the brim. On the COMEX, speculative long positions are at or near the highest levels ever recorded, matching the fever pitch of 2020 and far outstripping the 2011 cycle. The math is stark. A single gold contract controls $400,000 worth of metal, but only requires about $14,000 in margin. That is nearly 29 to 1 leverage. At those ratios, even a modest price slip can wipe out an investor's capital, triggering forced sales as margin calls ripple through the system. This concentration is not spread evenly. Recent CFTC data shows that a handful of large traders dominate the long side, with non-commercial net longs above 300,000 contracts, levels seen only at the most extreme speculative peaks. The sheer size of these bets means that any reversal, even a mild one, can set off a chain reaction. If gold drops by 10 or 15%, billions of dollars in speculative positions could be unwound in days, not weeks. ETF managers would be forced to redeem shares, selling physical gold into a market suddenly short on buyers. The fragility is built in. ETFs promise daily liquidity, but in a stampede, redemption requests can outpace the ability to source and deliver metal. Futures traders, operating on borrowed money, have little room for error. If the narrative shifts, if inflation cools or central banks pause their buying, the pressure can flip overnight. The same mechanisms that powered gold's ascent are poised to amplify any fall, turning a crowded trade into a race for the exits. The risk is hidden, but it is real, and it is woven into the very structure of the market. Fear is the fuel behind gold's latest run. Turn on any financial news channel, and you will hear the same themes. Inflation is out of control, the world's reserve currency is at risk, and geopolitical tensions are pushing the system to a breaking point. Headlines warn of trade wars, sanctions, and a new era of deglobalization. Social media amplifies every rumor while experts debate whether the dollar will survive another decade. The result is a feedback loop, where each new scare story drives more money into gold and pushes prices even higher. Yet the numbers tell a different story. Inflation, once the top concern, has cooled from its 2022 highs and now sits around 3 to 4%. That is hardly runaway, and far below the levels that triggered past gold manias. Central banks, after a record year of buying, are already hinting that their diversification goals are largely met. Official statements from Poland and China now say future purchases will be market-dependent, a subtle signal that the pace may slow if risks recede or prices stay elevated. The talk of de-dollarization is louder than ever, but the facts do not match the rhetoric. Most global reserves remain in dollars, and even the largest buyers, China, Russia, and India, still hold the majority of their assets in government bonds, not gold. Meanwhile, the media's obsession with gold as a portfolio essential has spread to everyday investors, many of whom are driven less by careful analysis and more by the fear of missing out. Viral posts and sponsored content push slogans like "gold to $10,000," feeding a late-stage buying frenzy. This is classic bubble psychology. When fear dominates, rational analysis takes a back seat. The focus shifts from what gold is actually worth to what someone else might pay tomorrow. The same emotional currents, anxiety about inflation, distrust of institutions, and worries over global conflict have powered every gold spike in history. Each time, the story feels new, but the underlying motives are strikingly familiar. It is not fundamentals driving demand, but the relentless churn of fear amplified by headlines and social media. That is the real engine behind gold's meteoric rise. January 1980. Gold hit $850 an ounce, up from just $100 4 years earlier. The world was gripped by 13% inflation, oil shocks, and talk of the dollar collapsing. On trading floors, the mood was electric. Brokers shouting orders, phones ringing off the hook, and headlines screaming that gold was the only safe place left. One trader at the time said that gold was the insurance policy everyone bought when the house had stopped burning. But the fever did not last. Paul Volcker, chairman of the Federal Reserve, stepped in with a policy few thought possible. The Fed hiked interest rates, not to 10 or 12%, but all the way to 20%. Mortgages, car loans, and business credit became punishingly expensive almost overnight. Inflation began to break, and with it, the rationale for holding gold at any price. The reversal was brutal. Gold tumbled from $850 to under $300 in less than 2 years. That was a collapse of nearly 65%. The headlines faded, the crowds vanished, and portfolios were left with deep scars. For those who bought at the top, it was a generation-long wait just to break even. Nearly 3 decades passed before gold climbed back to its 1980 peak, and that is not even adjusting for inflation. The euphoria of the late 1970s gave way to regret, as the so-called safe haven became a trap for anyone who chased the story too late. The lesson from 1980 is simple but unforgiving. When policy shifts and the fear that drove a bubble recedes, price alone is no protection. The speed and scale of the drawdown stunned even seasoned traders. Gold's collapse was not just a blip. It was a defining event, a warning, written in the numbers and in the memories of those who lived through it. In the aftermath of the global financial crisis, gold became the symbol of safety. Between 2008 and 2011, the price of gold soared from $700 to nearly $1,900 an ounce. The world was reeling from bank failures, housing collapses, and unprecedented central bank intervention. Quantitative easing flooded markets with liquidity, and headlines warned of currency debasement and runaway inflation. Investors, spooked by every new crisis, poured record sums into gold. Exchange-traded funds like GLD and IAU saw their holdings balloon, with those funds holding more than 2,600 tons by mid-2011. The story was everywhere. Gold was the only true hedge, a fortress against the chaos of modern finance. But as the panic faded, so did the narrative. Inflation remained stubbornly low, the dollar stabilized, and the global economy began a slow recovery. Starting in September 2011, gold's momentum faltered. The price began to slip, first gradually, then with gathering speed, and then a tumble. Over the next 4 years, gold lost nearly 45% of its value, tumbling to just above $1,050 by late 2015. The same funds that had absorbed billions of dollars in inflows now faced a torrent of redemptions. In 2013 alone, gold-backed exchange-traded funds shed more than 800 tons as investors rushed for the exits. Margin calls rippled through the futures market, and what began as a trickle of selling turned into a flood. The drawdown caught many off guard. Those who bought near the top, convinced by the crisis narrative and the promise of endless money printing, faced years of disappointment. While stocks and other productive assets began to recover and grow, gold languished. The lesson was clear. Gold's biggest rallies tend to be fueled by fear and momentum, not by lasting fundamentals. And when that fear subsides, the unwind can be swift and punishing. The 2011 episode stands as a stark reminder. What feels like safety in the moment can become a trap for those who arrive too late. Every gold mania brings a chorus of new excuses. In 2025, the story centers on trade wars, historic deficits, and the rise of China and Russia as gold buyers. The pitch is simple. This cycle cannot be compared to 1980 or 2011 because the world is facing unprecedented debt, fractured supply chains, and a global currency reset. But history is littered with these claims. The United States carried a debt to GDP ratio above 120% after World War II, only to grow out of it through decades of expansion. Trade regimes have shifted countless times, from the tariffs of the 1930s to the free trade booms of the 1990s and the protectionist waves that followed. Each era came with its own set of warnings, and its own version of this time is different. The reality is that gold's price is far more sensitive to sentiment than to any single macro headline. Central bank buying, often cited as proof of a new paradigm, is already showing signs of fatigue at these prices. Official statements from Poland and China now stress that future gold purchases will depend on market conditions. The pace of accumulation is slowing, not accelerating. Even the most aggressive buyers, like the People's Bank of China, still hold the majority of their reserves in government bonds, not gold. If inflation continues to moderate or global tensions ease, the logic behind further official sector buying weakens fast. Debt and deficits do not guarantee a higher gold price. The United States has run persistent deficits for decades, yet gold spent most of that time going nowhere. The same goes for de-dollarization. The dollar remains the world's reserve currency by a wide margin, and even in the face of political tension, global reserves are still overwhelmingly denominated in dollars. When every bullish argument depends on a single outcome, permanent crisis, it is a sign the cycle is late. The more people insist that this time is different, the more it rhymes with every speculative top that came before. Gold's ascent in 2025 has been anything but subtle, but the first sign of trouble often arrives without fanfare. By early 2026, prices hover near $4,700 per ounce, refusing to break higher even as bullish forecasts fill the air. For weeks, the market holds its breath. Then a single data release lands. It could be a softer than expected inflation print, or the Federal Reserve could hint at a dovish turn, signaling that rate cuts may come sooner than markets expect. Suddenly, the dominant narrative of endless stagflation begins to unravel. The fear that drove buyers into gold starts to fade, replaced by a cautious optimism about economic resilience. At first, the change is almost imperceptible. Trading desks notice the pace of central bank buying leveling off. Official statements from Poland, China, and India grow more cautious, emphasizing that any future purchases will depend on market conditions. A few large institutional holders quietly trim their positions, locking in historic gains. The price of gold, which had been climbing relentlessly, begins to plateau. For the first time in months, momentum traders see their bets stalling. The mood shifts. Analysts who once talked up $5,000 targets start to hedge their language, citing risks of a pullback if macro conditions continue to improve. Hedge funds, always quick to sense a turn, begin to lighten up on their leveraged futures positions. On the COMEX, open interest starts to drift lower as speculative longs unwind. In the ETF arena, new inflows dry up. The appetite for fresh risk is gone. It is not a headline or a crash that starts the process, but a subtle change in expectations. Gold, no longer the only game in town, finds itself competing with a resurgent stock market and rising bond yields. For investors who chase the rally late, the promise of easy gains is replaced by a creeping anxiety. The first domino has tipped. What follows is not panic, but a quiet, steady shift away from the trade that once seemed unstoppable. The silent trigger has been pulled, and the market's mood is about to change. The first cracks appear quietly, but the unraveling is anything but subtle. As the price of gold stalls near $4,700, a wave of leveraged bets begins to buckle under its own weight. On COMEX, traders holding massive long positions, many at 20-to-1 or even 29-to-1 leverage, watch as a modest pullback wipes out their margin. The math is brutal. A 10% dip on a $400,000 contract, backed by $14,000 in margin, leaves nothing but a margin call. Forced to sell, they dump positions into a falling market, triggering a chain reaction. At the same time, ETF investors, those who believed liquidity was just a click away, rush to redeem their shares. GLD and IAU, which together hold more than 3,600 tons of gold, face a torrent of redemption requests. In a single week, outflows hit 300 tons, rivaling the 2013 exodus that shook the market to its core. The process is not seamless. ETF custodians scramble to source physical bars, but in a true panic, the redemption protocol lags behind the selling. Market makers, forced to deliver metal, offload gold into an already saturated market, accelerating the slide. Redemptions pile up, and the market becomes illiquid at the worst possible moment. Maria Alvarez, a nurse from Arizona, feels the shock firsthand. She bought 30 ounces at $4,200, convinced by viral posts and the promise of gold as a safe haven. Now, with prices plunging past $3,500, her broker's margin desk calls. The equity in her account evaporates overnight. She scrambles to post more collateral, but the sell-off is relentless. Maria is not alone. Retail investors across the country watch as their paper gains vanish, their confidence shattered by the speed of the reversal. The cascade feeds on itself. Each new round of selling triggers more margin calls, more ETF redemptions, and more forced liquidations. Clearing firms tighten credit, raising margin requirements in the middle of the storm. Even the largest bullion banks, who once touted $5,000 targets, quietly unwind their own positions, adding fuel to the fire. By the end of the month, hundreds of tons have left ETF vaults, and the spot price has fallen by more than a third from its peak. The plumbing of the gold market, once an invisible safety net, now acts as a trapdoor. For those caught on the wrong side, the lesson is swift and unforgiving. In a crowded trade, exits are narrow, and the stampede spares no one. Gold's collapse does not end with a tidy landing. History shows that when momentum finally breaks, the fall overshoots, driven by panic, forced selling, and the sudden absence of buyers. By late 2026, the price has plunged far below the comfort zone of recent bulls. $4,000 gold is a memory. The market gropes for a new floor, but selling pressure remains relentless. ETF outflows, margin calls, and redemptions continue to dump hundreds of tons onto an already saturated market. Each bounce is met with more liquidation. This is the washout band, a zone where price and sentiment both capitulate. In previous cycles, gold's drawdowns have been brutal. After the 1980 peak, prices fell by nearly 2/3, taking decades to recover. The 2011 bust saw a 45% loss in 4 years. This time, the numbers look just as stark. From a high near $4,400, a 45% drawdown points to $2,400. But the market rarely stops at fair value. Forced sellers do not care about cost curves or historical averages. They sell because they must, driving the price even lower. The real test arrives as gold approaches $2,200 and then $2,000. Here, the price flirts with the all in sustaining cost for global miners, estimated between $1,200 and $1,400 per ounce. Below these levels, mines shutter, supply contracts, and the physical flow of new gold slows sharply. But in a panic, the market can overshoot even this floor. In past crashes, prices have hovered just above mining costs before stabilizing. For late buyers, the pain is severe. A 50% loss from the top is not a hypothetical. It is a historical pattern. The risk versus reward math at these depths is sobering. For every dollar of potential upside that tempted buyers at the peak, $2 or $3 of downside have now been realized. Every ounce held through the drop represents not just a paper loss, but years of missed opportunity, wealth that could have compounded elsewhere. The washout ends only when the last weak hands are forced out, and the price finds support not in hope, but in the hard economics of what it costs to pull gold from the ground. Only then does the market begin to heal. Right now, nearly $19 trillion sits locked in gold, an asset that produces nothing, even as markets reward growth and innovation. Each new bubble entices, but history shows how quickly fortunes reverse. In a world where compounding drives real wealth, every year spent waiting on gold is a year lost. The choice remains: let fear dictate your future, or put your capital to work building it.